slow. What I've done here is try to respond to the questions of what kind of recovery it's been. The yellow line on this chart is the current recovery measured by growth in GDP since the bottom. We're 5 quarters into the recovery, so this would be, it turns out this is June of last year, and this would be September 30, or through September 30. And we've come back about, we lost 4.1 percentage points of GDP during the recession, and we're back about 2/3 of the way, 2.8 points or so, or something in that order. And it's stronger than the 01 recovery, and the 01 recession was very mild. We remember here because of the tech bubble burst, and I'm sure the folks in the Silicon Valley remember it for that, and some other places. It was a very short recession. Some of you couldn't even remember when it started. March of 01, and when it ended, November of 01. It was very short, hardly qualified as a recession, except job loss continued for 25 consecutive months after the recession was over. So those of you who are in the employment market in some fashion, as you are, you may have a better sense of it. It was a very slow recovery. And here's the 91 recovery, which is really hard to remember, except we lost 53,000 jobs in 1991 in the Washington area. And so we felt it here, sort of the hangover from the S&L crisis. That isn't the only explanation. And here's 82. Man, just came out like a rocket. But what you can't tell from this is that there was a recession in 80 that went a short recession, and then there was about 7 or 8 months of recovery, 9 months in early 81, and then by the September of 81 we were back into a recession. It wasn't a double dip. Double dip has to come faster than 6 months, or it's 2 separate recessions, so we can't have a double dip now. It's just 2 recessions close together. But a lot of what went wrong with the economy in the late 70s and into 80, 81 got corrected by the time the 82 recession was over in December. And so the correcting process, also a very different economy. So here we are. It's not quite as bad a recovery as we have the sense. We've been given the sense. Except behind that yellow line is what we should be concerned with. And what's behind that yellow line is that most of what's been growing isn't bought and paid for with current dollars. It's been subsidized. About 60% of it was backfilling inventories. Businesses were really quick to pull the plug this time around. They cut jobs and they stopped replenishing inventory. They stopped spending money very, very quickly into the downturn. Often in 01, they hesitated to lay workers off until the recession was over almost, and then they found that they needed to cut back in order to get whole again, and they kept cutting in 02 and through mid-03, well into 03 before they started. It was the 4th quarter of 03 before they started hiring again. So about 60% of that yellow line was backfilling sales that had taken place in an earlier time. A little bit of export activity in there. About half of the remaining 40% was stimulus, again printed money, and the other half, at best 20%, was real purchasing power, and it mainly came from businesses. So very little consumer spending. Consumers haven't been much of this, although retail sales have gone up recently. They're going up faster than earnings, which is somewhat, I guess it's encouraging, although it's coming out of savings, not out of credit card debt. It's an interesting pattern to watch. Credit card debt has gone down for I think, as many as 25 consecutive months. The total debt on plastic. It's really expensive debt, and anybody that could get out from underneath that got out from underneath it, and they maybe funded it with other debt, which is cheaper. which is good. I mean, but total consumer debt is going down, savings are going up, and as purchasing's starting to pick up, it's increasing faster than incomes. So it has to come from somewhere, but it isn't debt. And that's sort of pointing to a conclusion that the recovery that we're going to see here as we go out is going to be a fairly mild recovery, because people aren't going to spend way out in front of earnings like we've been doing for the last 30 years. It's more than just a generation. It's a couple generations we've been spending faster and faster because of all the neat stuff that we want and we haven't wanted to be denied like generations earlier. This is